Assalamualaikum and very good day to Dr. Azlina and all my fellow friends. We are Grenade and we will be presenting to you on the topic of liabilities. Before we are heading to our presentation of the liabilities, these are the subtopics that we will be focused on this video. First of all, we will begin with definition of liability. Next, the classification, financial liability, provision, contingent liability, other liabilities, related issues, and summary of all subtopics that will be discussed in this video. So, stay tuned. As you guys can see, here are the statement of financial position of Fraser and Neef Limited. We have group accounts of financial liabilities, provisions, and other liabilities. And also, they are not of the account of Fraser and Neef Limited in contingent liabilities. Before we dive into more information about liability, we need to know what actually liability is. Liability is a present obligation of an entity which the settlement is expected in an outflow of economic resources as a result of a past event. From this definition, we know that a liability only exists if it satisfies three criteria. First, present obligation. Second, outflow of economic resources. And third, result of past event. According to EPPA4123 there are two types of obligated event, which are legal obligation and contractual obligation. Legal obligation is an obligation that derives from a contract through its explicit or implicit term, legislation, and other operation law. For example, court case and warranties. Constructive obligation is an obligation that derives from an entity's action or practices that created a valid expectation from the public that it will discharge their responsibilities. For example, is environmental policy. This article can be both fall into two situations, either legal obligation or constructive obligation. If we categorize the article as legal obligation, it because red salt causes contamination, but cleans up only when required to do so under the laws of the particular country which it operates. While the other situation, if we want to categorize the issue as constructive obligation, it because Repsol has widely published environmental policy in which it undertakes to clean up all contamination that it causes in a country where there is no environmental legislation. Entity can present liability in statement of financial position in two ways. The first one by separate between current liabilities and non-current liabilities as shown in statement of financial position of capital A. The other one is by list it according to its liquidity as shown in statement of financial position of Malayan Banking Berhad. We have four types of liabilities. They are consist of financial liability, provision, contingent liability, and other liabilities. This type of liabilities will be discussed more in the other part of this video.
I am Izani and we will go further into the financial liability by referring standards MFRS 9 for financial instrument and use with MFRS 132 and 7. By referring the definitions, financial liability arise when we got contract obligation to deliver in terms of cash or financial assets to another entity or in terms of exchange financial assets or financial liability to other entity by consider the unfavorable potential to the entity, or when a contract that will or may be settled in the entity owns equity instruments using non-derivative or derivative instruments. We only recognize financial liability when entity become party to the contractual provision of the instruments. Entity recognize all its contractual rights and obligation under derivative as assets or liability, except for derivative of financial assets that can be recorded as a sale. And for the derecognition, we have extinguished, which happen when the contract has been discharged, cancelled or expires. And also we have exchange and repurchase. For classification financial liability, we have 5 classes, which are amortized cost, and second we have fair value to profit loss, third transferred financial assets that is unqualified for the recognition or continuing involvement approach applies. Fourth, we have commitment to provide a loans at below market interest rate, and lastly we have financial guarantee contract. If you zoom at the fair value to profit loss, we have items such as financial liability for tradings, derivative financial liability, and contingent recognition that's considered for business combinations. By referring Maybank Berhad financial statement for 2021, we have highlighted the financial liability at amortized cost. The item considered are deposit from customer, bill and acceptable payable that is shown at financial position. Then, if we move to note 23, we can see the details on the deposit from customer. At the note in the accounting policy, the entity also mentioned about the item that is categorized under the amortized cost. As example, Maybank Berhad item are payable, bill and acceptable payable. I also mentioned about the measurements. As you can see, we already highlight the yellow color for the initially measurements and the green color for the subsequent measurements. As another example from a finance, they are mentioned about the non-derivative financial liability are grouped in the other financial liability. They are initially measured at fair value less directly attribute transaction cost and the subsequent measure at amortized cost using the effective interest method. Next example are financial liability at fair value to profit loss. By referring Maybank Berhad financial statement for 2021, at the financial position, the items stated are financial liability at fair value to profit or loss. And by referring the notes 25, you can see the detail about the item. Referring note 25, they are also mention the disclosure about combination FVTPL and designated FVTPL. If you rewind the video, both items are disclosed as financial liability at fair value to profit or loss. In the standards MFRS 7 para 8.E, FVTPL and designated FVTPL actually need to disclose separate, but Maybank Berhad choose to disclose both of them into one item. This is because the amount of designated fair value to profit loss are not significant to disclose as one item at the financial position. In the income statement, the portion that released in the current year was stated in the group of other operating income. By referring note 41, the component related to the financial liability can be filed. As you can see, as the highlighted, it is the realized loss on financial liability at fair value to profit loss. In the notes in their accounting policy, entity also mentioned about the item and measurement. As you can see, we already highlight the purple color for the item and yellow color for the measurement. Here are another item that is measured at fair value to profit loss. The example of derivative component includes trading derivative, interest rates, equity related, community related contract, credit related contract, and interest sales related contract. Then we go to the financial guarantee contract. At the financial position, they are labeled at other liability. So by referring notes 27 on other liability, we can find the item as allowance for impairment losses on loan commitment and financial guarantee contract. We go further at the notes, we can see that the item are details into the ECL stages. In the note from their accounting policy, we already highlight the initial measurement at the yellow color and the green color for the subsequent measurements. Next is about the measurements of the transferred financial assets that's unqualified for the recognition or continuing involvement approach applies. The financial assets need to be recognized as financial liability. So we need to choose either to use amortized cost or fair value by referring the previous recognition of the financial assets. Measurement for the item that is classified as commitment to provide a loan at a below market interest rate and financial guarantee contract will be measured at the higher of the loss allowance that is determined, and when the initial amount is less, we will be referred to the MFRS 15 for the record. At the disclosure, by referring MFRS 7, there are two requirements that need to be disclosed. First is about the significance of financial instrument for financial position and performance. Those can be disclosed at the statement of financial position and statement of comprehensive income, and also other disclosure. Second, we need to disclose about the nature and extent of risks that are arising from the financial instrument. Those are about the qualitative and quantitative disclosure that can be used on the credit risk, liquidity risk, and market risk. Next, we will be see the example for the nature and extent of risk arising from the financial instrument. We also provide you with additional handout on the financial liability. Do take your time to read the notes. Now, we will continue the video with the next topic of liability, which is provision.
I will proceed with second type of liabilities, which is provision. What is provision? Provision is a liability of uncertain timing or amount, meaning that there is some question over either how much will be paid or when this will be paid. We can see the difference between liability and provision by this example, which is account payable, categorized as liability because we know when to pay and how much the amount to pay. It differs with the provision, which in example is warranties. Warranties categorized as provision because we have the estimation amount for the warranty based on the last experience, but we can't expect what the time customer will claim their warranty. Next, we move to the recognition of provision. Entity have to meet all these three conditions in order to recognize a provision. First, entity has a present obligation, whether legal or constructive, as a result of past event. In rare cases, for example, lawsuit, it is not clear whether there is a present obligation. In these cases, a past event can give rise to a present obligation if, taking account all available evidence, it is more likely than not a present obligation exists at the end of the reporting period. Next is only obligating event, either legal or constructive, that occur will be recognized. Second, there is probable outflow of economic resources represent economic benefits. An outflow is regarded as probable if the event is more likely than not to occur or numerical the probability is more than or equal to 50%. And third, entity can make a reliable estimate amount of the obligation. But when no reliable estimate can be determined, entity shall disclose this liability as a contingent liability. And most importantly, as I mentioned earlier, entity have to fulfill all the conditions to recognize a provision. But if any of these conditions is not met, no provision may be recognized. Now, let's look at the measurement. According to MFRS 127 paragraph 36, the amount recognized should be the best estimate of the expenditure required to justify the obligation. How entity determine the best estimate? Before that, I will explain what the best estimate means. The best estimate, it is the amount that an entity would rationally pay to settle the obligation at the end of the reporting period. The risks and uncertainties shall be considered in reaching the best estimate of a provision. Entity might use judgment based on past or similar transaction, discussion with expert, and any other pertinent information. Besides that, to reach the best estimate amount, entity must consider all these three factors. First, risks and uncertainties. Entity must consider the risks and uncertainties that are avoidable surround many events and circumstances, for example, inflation. Second, time value of money. If entity expect to settle the obligation beyond 12 months after reporting period, then the amount of provision shall be represent value of the expenditures required to settle the obligation. And the last one is future event. If there is enough evidence that future event will occur, then it shall be reflected in the amount of provision. Apart from that, IFRS 127 also specifies the treatment of provision in a few specific situations. The first situation is future operating losses. Provision shall not be recognized for future operating losses because it do not meet the definition and recognition criteria of a provision. Second, onerous contract. Onerous contract are those in which the unavoidable cost of fulfilling the contract exceed the economic benefit from the contract. Thus, the amount of provision should be the lower of net cost of fulfilling the contract and the penalty arise from failure to fulfill it. And third is restructuring. Restructuring is a plan of management to change the scope of a business or a manner of conducting a business. A provision of restructuring must be recognized when two conditions are met. First, entity has a detailed formal plan that provides minimum information, such as the location affected and the number of employees who will be determined. And second, a valid expectation must have been raised by entity to those affected parties. Next is disclosure. Based on statement of the financial position of capital A, we can see the entity classified their provision as current liabilities. So let's see where does this amount come from. According to IFRS 127 para 84, entity shall disclose all of the following amount which are carrying amount, additional provision made in the period, amount used during the period, unused amount reversed, and the increase in the discounted amount. And you can see capital A disclose all the information as required.
Next, we will explain another liability, which is contingent liability according to MFRS 137. According to MFRS 137 Para 10, contingent liability can define as: first, a possible obligation whose existence will be confirmed only by the occurrence or non-occurrence of uncertain future events; or second, a present obligation that arises from past events but is not recognized because the required outflow to settle the obligation is not probable or the amount cannot be measured with sufficient reliability. There are three types of contingent liability. First is probable. Probable is the future events are expected to occur. It means that the probability of the liability become real is higher and the amount of the liability can be estimated. And the second is possible. Possible means that the probability of liability is uncertain or the probability is certain but the amount of liability cannot be estimated. And the last one is remote. It means that the probability of future events liability will occur is very small. Here is the guideline for accounting treatment based on the outcome. If the outcome is virtually certain or probable, the company will disclose probable liability in the statement of financial position as a provision and not to the account. If the outcome is possible but not probable, it will be not recorded in the statement of financial position, but the company will disclose in the note to the account. If the outcome is remote, company does not need to be disclosed neither in the statement of the financial position or not to the account. Here are the examples of how Sindabi disclose contingent liability. As you can see in the Note 45, company disclose material litigation between subsidiary of Sindabi and other incorporated group. In this case, the lawsuit is certain, but the amount of outflow cannot be estimated. Therefore, it disclosed as contingent liability. For the significant accounting policy, Sindabi state the definition of contingent liabilities according to the MFRS 137 Para 10. According to the MFRS 137 Para 86, companies should provide a brief description of the nature of the contingent liability and with an estimate of its financial effect, an indication of the uncertainties relating to the amount or timing of any outflow, and also the possibility of any reimbursement. Here are the difference between provision and contingent liability. The occurrence of provision is certain while the occurrence of contingent liability is conditional. Provision are liability which are certain which will require outflow of funds, while contingent liability are liability which are not certain which may or may not require outflow of funds. For the estimate of liability, provisions are measured at the best estimate including risks and uncertainties of the expenditure required to settle the present obligation and reflect the present value of expenditure required to settle the obligation where the time value money is material, while the amount of contingent liability cannot be measured reliably or because settlement is not probable. And another difference are any increase or decrease of provision is recognized in the financial statement, while the contingent liability is not recognized in the financial statement, but they are disclosed as a footnote in those statements. The example of provision liability including product warranty and provision of aircraft maintenance for airline company. while the example of contingent liability including outstanding lawsuit and also pending investigation.
Next, we will be discussing about other liabilities. In this topic, we have four other liabilities, which are contract liabilities, lease liabilities, deferred tax, and lastly, employee benefits. First, I will be talking about contract liabilities, which can be found in MFRS 15. As you can see in this presentation, here are the examples of how contract liabilities shown in the financial position. In this example, I will be using the FNN company as our reference. The details about contract liabilities can be found in the note 20 as shown in the second picture of this presentation. Generally, contract liabilities is an entity's obligation to transfer goods or service to a customer for which the entity has received consideration from the customer. In simple terms, it is when the entity has invoiced the customer or received payment from them but has not yet done the work and the invoice and payment exceed the revenue recognized to date. Next is about the company significant accounting policy. First, I will be talking about the MFRS 15 para 53, where in this para, we'll be focusing on variable consideration. In this example, the company applies the maximum achievement criteria of set targets. The amount of consideration will be recognized as liabilities for the expected future incentive. Next is about MFRS Para 9, where in this para we'll be focusing on identifying the contract, where in this example, the company identified the contract when certain customer pay purchase consideration to the group before the transfer of the goods to the customer.
Next, we will move to MFRS 16, which is lease liabilities. Above is an example for statement of financial positions from Pharma Niaga. In the statement above, the lease liabilities are disclosed in current and non-current liabilities, and further explanation are recorded in Note 13b. From Note 13b, the lease liabilities shown are the total amount of combination of current and non-current lease liabilities. Note 13b also shown the reconciliation of lease liabilities, which the table illustrates the changes in lease liabilities, including the changes from cash flows and non-cash changes during the financial year. We can see that with the reduce in net cash flow and the addition in interest charges, acquisition or assessment of right of use, and foreign exchange movement, the lease liabilities is reduced from 2,141,000 ringgit at the opening balance to the closing balance, which is 1,634,000 ringgit. For the significant policy, Pharma Niaga disclosed the lease liabilities under MFRS 16. Pharma Niaga has initially measured the lease liabilities at present value. They are not paid at that date under Para 26, where the lease payments are discounted using the interest implicit or lessee's incremental borrowing if the interest rate cannot be determined. Under Para 27, the payment that can be recognized as lease liabilities are, firstly, fixed payments less any lease incentives receivable. Second, variable lease payments that depends on an index or a rate, such as payments linked to a benchmark interest rate. Third, amount expected to be payable by the lessee under residual value guarantee. Fourth, the exercise price of purchase option. And lastly, payment of penalties for terminating the lease. For subsequent measurement, Pharma Niaga allocate lease payment between principal and finance costs, as finance cost is charged to profit and loss over the lease period to produce a constant periodic rate of interest on the remaining balance of liability for each period. Looking at the reassessment of lease liabilities, Pharma Niaga exposed to potential future increase in variable lease payments that depends on an index or rate, which recorded under Para 42b. When the adjustment of lease payments based on an index or rate take effect, these liabilities is remeasured and adjusted against right of use asset, which recorded under Para 39.
Next, I will be talking about deferred tax, which can be found in MFRS 112. Here is the example of how deferred tax shown in financial position. In this example, I will be using Maybank Company as our reference. The detail about deferred tax can be found in note 29, where you guys will see it in the upcoming slide. Generally, there are two types of deferred tax, which are deferred tax asset or deferred tax liabilities. In this presentation, I will only discuss about deferred tax liabilities, where deferred tax liabilities are the amount of income tax payable in future period in respect of taxable temporary differences. Deferred tax liabilities occur when the company is able to defer paying tax on profit. The deferment happened because tax law allowed the company to delay reporting the profit as part of taxable income in particular period. Next is recognition, where a liabilities for the income tax deferred is recognized when there is taxable temporary differences. Taxable temporary differences happen when either carrying amount of liabilities in the financial position is less than tax base, or when carrying amount of an asset in the financial position is more than tax base. Differences happen when accounting income is more than taxable income, which cause future taxable amount and create deferred tax liabilities. Here are the Maybank accounting significant policies. First, I will be talking about MFRS 112 Para 74, which are highlighted in the orange box. This para explains about the condition when an entity shall offset deferred tax liabilities. In Maybank policies, entity must has a legally enforceable right to set off current tax asset against current tax liabilities and the deferred tax liabilities related to the same taxation authority on the same taxable entity. Next is about para 47, which are highlighted in the blue box. This para explains about the measurement of deferred tax liabilities. Maybank measure deferred tax liabilities at the tax rate that are expected to apply to the year when the liability is settled. Moving on to the next para, which is para 15 and para 39, which are highlighted in the red box and purple box. This para explain about recognition of deferred tax liabilities. Anyway, in the highlighted box, Maybank explain about the condition where Maybank may not be recognized as deferred tax liabilities. In para 15, deferred tax liability may not recognize when deferred tax liabilities arise from the initial recognition of goodwill and at the time of transaction affected neither accounting period nor taxable profit. In para 39 is related with investment in subsidiaries, branches and associates and interest in joint agreements. Deferred tax liabilities may not recognize when these conditions are satisfied, which are the parent, investor, joint venture or joint operator is able to control the timing of the reversal of the temporary differences, and it is probably that the temporary difference will not reverse in the foreseeable future. This is the detail about deferred tax, which can be found in note 29 of Maybank annual reports. Audience may pause for a moment at this part if any of you want to observe the reports.
Next, we are going to look at employee benefit under MFRS 119. Here are the examples of how FNN Holding Berhad disclose employee benefit in financial position under category liability. In Note 18, we can see the movement in the net defined benefit liability. The closing balance for net defined liability can calculate by adding opening balance plus expenses related to defined benefit plan in current year plus the measurement of the net defined benefit liability which under MFRS 119 para 127 to 130 and then minus the benefit that has been paid. For the significant accounting policy, FNN Holding disclosed several types of employee benefit under NFRS 119. In Para 11, company disclosed the short-term employee benefits such as salary, bonus, pay leave, and other expenses-related service that provided. Company also recognized the expected cost of profit sharing and bonus payment according to Para 19. Step plans such as EPF also recognized according to Para 43 to 45. For the defined plan benefit, which disclosed in financial statement in previous slide, the group using actuarial technique, which the project unique credit method, to determine the deficit or surplus of employee benefit according to the Para 57A. The group also remeasurement of the net defined benefit liability according to the Para 57D and determine the net interest to the net defined liability by applying the discount rate according to the Para 83. For future explanation and understanding, you guys can refer to MFRS 119.
Now, we will move on to the related issue. The issue that we choose is creditors in difficult position as cash-strapped Sapura Energy bites blood again, taken from the Age Markets. This article is related to the impact of COVID-19 brings to the company's liabilities. So, what is the issue? Due to COVID-19, many companies need to adjust their operations, and some may plan longer-term changes, including Sapura Energy. Due to the direct delays arising from the movement control restriction measures and related standard operating procedures, the Sapura Energy operation has been affected, and this resulted in additional costs to them. To come over the circumstance, the management may consider downsizing or discontinuing some specific operation through a restructuring plan. What is a restructuring plan? A restructuring plan are recognized only when an entity has detailed formal plan for the restructuring and has raised a valid expectation in those affected that it will carry out the restructuring. In other words, a restructuring plan can be defined as a provision for restructuring costs and is recognized only when the entity has a constructive obligation because of the main features of the detailed restructuring plan have been announced to those affected. Why Sapura Energy are going for a debt restructuring plan? This can be seen at the diagram on the right. The diagram shows that the Sapura Energy debts remain at a high position, which their short-term borrowings are exceed 10 billion ringgit in October 2021, while their net cash generated from operations are not enough to cover the financial cost paid throughout the 4 years starting with financial year of 2019. The impact that brings to Sapura Energy is that they need to maintain ready access to the capital markets and to preserve the ability to repay and service debt obligations over time. What can be seen is that Sapura Energy has announced that the group and 22 of its wholly owned subsidiaries to obtain 2 orders from High Court of Malaysia for the purpose of solving the issues of their debt. The 2 orders are: 1, an order to convene meetings with creditors to consider and approve a proposed schemes of arrangement, and 2, a restraining order to restrain and stay all legal proceedings against the applicants. Sapura Energy has made 3 exercises to restructuring their debt. Firstly, they implement the proposal of scheme of arrangement, which is for every 1 ringgit in liabilities owed, 25 cents will be refinanced, 20 cents will be converted to perpetual non-tradable in-kind notes of 5% coupon per annum, and the remaining 55 cents will be converted to perpetual non-tradable zero coupon notes and converted into shares in subsidiaries, which are Sapura Drilling Sdn Bhd, Sapura Technology Solutions Sdn Bhd, and Sapura Geoscience Sdn Bhd. Next, Sapura Energy are intent to secure interim funding from Permodalan Nasional Berhad, which is their largest shareholder with 40% of the company shares, and their former president Tan Sri Syahril Samsudin, which is their second largest shareholder with 13.91% of the company shares. This funding may help them to continue operating as going concern. Lastly, Sapura Energy has sold off 50% of their Sapura OMV, which is their asset, to Australia OMV for $890 million, which is around 3.73 billion ringgit, and is considering that the oil price is at a 7-year high, and it is capable to recover the price of sold asset with ongoing project in Sarawak.
That's all from us. Thank you.